Good evening, ladies and gentlemen, and welcome to tonight's live stream. A little tardy today, had some connection issues with all of the streams, but I seem to have figured that out. And so welcome to tonight's live stream. If you have any questions, please go ahead and put those in the comments and I'll deal with them as we go along. And if you are having any difficulty hearing me, if you could just simply let me know and I will make some changes to that, make sure the microphone is close enough here. Tonight we're going to be talking about a great many things. Hey, Susan, thanks for joining us today on LinkedIn. Really great to see you. We have a packed session tonight. I've put in a lot of data, put in a lot of research for you, so I hope you enjoy what we're going to be talking about. The email that I sent out earlier today talked about what a little bit of what we're going to talk about. So I'm going to do a market update with you. We're going to talk about inflation. We're going to talk about high prices of oil. We're going to talk about real estate. We're going to talk about investing strategies during market volatility. It is a jammed session, so I'm going to try to get through it as fast as I can. You know, I love these colossal long sessions, but I've heard your comments and I know you want me to keep it brief. So I'm going to blast through this as fast as I can. But again, put your comments below because I do want to hear from you, want to hear what your thoughts are. If there's something you want me to elaborate on, you know, this is your time. It's different from the sessions that I do throughout the week where I try to keep them under, say, 15 minutes. On these live streams that happen at 7 o'clock on Wednesdays, this is your time. I have an agenda. I'm going to give you some of my information, and it'll be the evening will be loosely based on those topics. But as you have some comments or some ideas or concerns, fire them at me, and we're going to talk about them as we go through that. Okay. So without further ado, I am going to get into this. Hi, Ivan, all the way from the West Coast. Thanks for tuning in today. Wow, middle of the day for you. So thanks for taking time out of your early evening to join us. Okay, you're all set for this because we're going to just blast through some of this stuff, okay? So by the way, if you're new to this channel, if you're new to seeing me live, I go live every Wednesday at 7 o'clock. I'm an advisor that works with clients right across Canada. Business owners, individuals, families. I manage their assets. So people ask me, do you just do videos? I do videos for your enjoyment, for your education. This is all about your education tonight. 100%. You're not going to find any products in this session tonight about why you should buy such and such financial institutions product. This is all about your education. So it's all about you. I have a YouTube channel where I put all these videos. So head on over to the YouTube channel. If you've never been there, hit the subscribe button. And I think you're going to love the material that I deliver. Okay, so the first thing is we're going to talk about a market update. I'll see if I can manage these controls again. There I am at the bottom. Okay. We're going to be talking about a market update. That's the first thing we're going to talk about. So I'm going to lead you through a few slides to give you sort of a sense of where are we coming from and where are we at today. There's a 3-year return. It's a lot of lines, but I'll bring it close. Just pay attention to that one dark red line. You see it going straight down in the middle of the screen there. That is oil. Okay, that's crude oil prices. So I wanted to put that on there because that is one of the areas that I'm going to be focusing on tonight because it's one of the areas that Joe Biden is focusing on, trying to figure out how to get oil to come down. Oil is a big problem and is the source of a lot of the inflation that we're suffering under today. But here you'll see these are all the major North American indices, the Dow Jones, the NASDAQ, the S&P 500, the S&P TSX, that's our Toronto stock market. So those are the lines you see there. The yellow line, that's the Toronto stock market. You can see the 3-year returns are absolutely, and anybody want these slides, just let me know. Put a comment in put your comment in whatever channel you're on, and I'll be sure to send you these slides. But these are some amazing returns over a 3-year return, but it gets progressively worse as we move into COVID. There's a 1-year return of the same indices you see now. We are now negative. Oil going through the roof. So if you've got energy in any of your portfolio allocation, you're seeing largely why your portfolio might be hanging on or gaining ground is because you've got a good energy allocation. So oil is going up, and naturally you're getting good returns there. But everything else is selling off. If you look at the Toronto stock market, it's negative almost 3% for and this is closing values of today, by the way, right? So the Toronto stock market, oh my goodness, the Toronto stock market is negative 3%, almost 2.74. And everything else in the US is severely negative almost 11% on the Dow Jones. The S&P 500 is almost negative 11%. The NASDAQ is even worse. Okay, and then here we are year to date. Year to date, I should get my picture out of the way and see if that helps, right? Like, there we go, okay. And you can see there that the NASDAQ is minus 35%. This is a problem. This is why I wanted to talk to you all today, because I know this is on your mind. I know that these markets are weighing heavily on you, and you're wondering, what do we do? And some of you are panicking. Some of you are, I've seen this before, I know what to do. I'm going to sort of get into how this works depending on where you are in your cycle of investing, in your life cycle, in terms of where you are in your career and retirement, and how it works for you. Some people look at this chart and say, I see opportunity all over the place. And other people look at this chart and say, how am I going to retire? So it's all relative. I'm going to kind of stealing my thunder in one of the slides, but let's look at this. This is a really great slide that talks about, I call it manufactured implosions. You know, I started my career in financial services just before the dot-com bubble bursted. And that was my baptism into the fire of investing. And so you can see there, the first red circle, that is the dot-com bubble. And look at how it's building up. And I put in all those other 1980, 1990, 2000, 2010. And you can look at the things that were going on I'm not going to go back to the 80s, but if we look at just 1990, the Gulf War, the Asian crisis, the Fed raises rates 6 times that decade, and Y2K fears. For those of you who are not old enough to know, yeah, we were freaking out when the clocks were going to change to the year 2000. We thought planes were going to follow the sky. I mean, you think today is a problem. If anybody's old enough to remember that back in the 2000s, if you're old enough in terms of working and so on, I remember what everybody was thinking. Will our computers stop working? Will airplanes follow the sky because their clocks aren't going to be able to roll over to the new year? It was a tremendous time of great unknown, and yet you look at what happened. The markets just ran up pretty well after 1995. The markets were just skyrocketing, and then we hit a bubble in 2000, and that bubble burst. Okay, and so in that particular, I'm not going to go into history of what happened in the tech bubble, but you can see what I'm trying to say is that was a manufactured time. It was all based on speculation, and people were buying stocks and companies that hadn't made any money. All they had was an idea, and the valuations were out of control. And then when we all came to reality, that bubble bursted. But look at what happened in the 2000s. This is the lost decade. Now, for all of you that are really, really nervous, and you're old enough my age, then you can remember what the 2000s looked like in terms of the lost decade. People who were in that timeline, in that 10-year, look at what happened to their portfolios. They went from a high in 2001, or 2000 we'll call it, and then shortly after that we had 9/11. It was like crazy time. It was really not an easy time to invest in that decade. And you can see we went into a recession in 2008. So you can see that there's been periods where people weren't able to make money in their portfolios for an entire decade. It was very difficult to do that. Now, you had to be very careful about what you invested. That's where you could actually make money. If you were just simply doing some index investing, it was really problematic for you. Okay, so now you look at from 2010 going forward, and look at the craziness that happens there. That is manufactured, 100%. You cannot honestly look at that chart and tell me that looks natural, that kind of growth is natural. It's not natural. What changed in that period of time from 2008 going forward is the governments around the world said, we're just going to print money. We don't have to worry about anything because we have now given ourselves a pass, a stamp, and that stamp is print as much money as you like. That is the answer to our problems. We're not going to allow the great recessions that happened in the past to affect us. We're going to spend our way out of those problems, and we'll just push this problem that we're obviously going to face down the line. And the next government's going to have to deal with that when that happens. And that is exactly what's been going on. And so I want you to understand why it is that your assets have gone up so dramatically, and that is because of when you lower interest rates. I've said this in other videos, but when you lower interest rates next to zero and you flood the market with money, everything becomes cheap. You can get loans, access to capital becomes very cheap, and you can buy and do whatever you want. It elevates all of your assets. So now the reverse thing is happening. Now they're pulling money out of the market. They're not going to be flooding money into the market anymore. And so when that happens, asset prices come back down. That's exactly what's happening right now. So that's why you see that red circle I've got there. That is the unnatural stock market, which is beginning to find its equilibrium. And that's kind of what you're worried about right now. And remember, if you have any questions or comments, go ahead and put them in the chat and I will get to them as we go along, okay? Okay, this chart here shows bulls versus bear market. And why I'm sharing this with you is because you're all worried, rightly so, about the markets and are we going to go into recession and when is it going to happen and how long is it going to last and what will that mean for me if I'm going into retirement, or is my job at risk if we go into recession? There's all these unknowns, and that's why the market is why it's behaving that way, and it's why everyone has these fears. And so I just want to just sort of give this to you. Out of every bear market, out of every recession follows 7 to 10 years of bull markets. So it's not make-believe. Just look at this chart. Those solid big green lines above the 0%, those are all of the periods of growth in the stock market and the duration, okay? And the dark blue below the line, especially with the red circle there, that's your 2000, that was just dismal, the .com. You can see that one lasted for about 25 months. The lowest point in the stock market was minus 43%, and that recession lasted 25 months. The 2008 didn't last that long. It was 11 months, I think it was. And then the one you see in the very far right side next to my picture there, that actually lasted 2 months. That was your COVID, okay, down negative 22%. So you can see that the negative reaction to the market is not unusual. It's quite common that the market's going to drop at least 20% because that's how you get into recession. A recession is defined by having at least a 20% negative decline. And we see that right now in the US markets. We're not seeing that right now, obviously, in the Canadian market, but it's fair to say that we're in a recession already. They haven't come out to say that. They're probably going to say that a month or 2 months from now. Say, by the way, we entered a recession 2 months ago. But this is the reality of what we're in right now. So I just wanted to just highlight this because on the other side of what we're probably going to be going into are going to be 7 to 10 years of bull markets. So I'm going to prepare you in this presentation as to what you need to do in order to sustain yourself through that 2-year period. Again, nothing's new here. We've gone through this, as I've shown you in the other slides. We've gone through this before. So here are exactly what I'm saying. The bull runs follow recessions. Those gray vertical lines are recession periods all the way back to 1940. And you can see, if you just take 2010, the vertical line go all the way up, you'll see the market was declining ahead of the recession, right? And then during the recession, the market started to recover. So this is what I want to point out to you is that in all of those instances, and those are all of the indices that you see, US stocks, international stocks, Canadian bonds and treasury bills, and inflation's in there. The recession, the markets begin to recover during the recession. So it's not after it ends, it's actually, you'll see the market will begin to turn. It's turning now, we're going down, and we're going to have a period of probably some very uncomfortable times in the markets, and I'm going to share with you exactly what you're going to probably experience. But the market always recovers during the recession and goes to new highs. So we have to figure out a way how you're actually going to sustain yourself through this period, okay? Another thing to look at, I'll get my picture out of the way again. This is Canadian stocks after market downturns. Here's some this is research, some statistics for you. Early 80s, forget about it, but .com, there's 2000, and then the global financial crisis in 2008. Look at the way those markets actually improved after a downturn. So again, just some more fuel, some more information to help you to see that this is a normal cycle that we're going through, even though that the way it was created is not normal, it was actually manufactured. But what I want you to pay attention to is this. This is the first tip about how you're going to have to invest going forward. Index investing, we call it passive investing, is going to be very difficult over the next few years. It's going to be very difficult for you to, and so if anyone doesn't fully understand about index investing, essentially what we're talking about here is a lot of people will say, if I just put my money in the index versus actively managed portfolios by advisors or financial institutions doing asset allocation and so on, if I just bought myself an ETF that had the Dow Jones, the S&P 500, I'm going to be fine, or the TSX if you want to stay in Canada. I'm going to be fine. I can just put my money there and just passively get whatever the market's going to bear. Those days are going to be very difficult going forward over the next few years because we're going into likely a recession where the markets are going to be negative or flat. We're going to see very little growth in the market. In fact, with interest rates going up, we just saw today in the US, they raised interest rates 0.75%. They're likely going to do a similar thing in Canada next month. So that is forcing the economy to slow down. Growth is going to slow. So for you to be investing in a passive way, your returns are really going to suck. I don't know how to say it any other kind of way. So you really need to be thinking differently about how you're going to invest. And that's what I'm going to share with you exactly how to do that. So you need to rethink your investment strategy going forward. So the first thing I'd like for you to do is just review your risk tolerance. As we move into negative returns, we have 6 months of returns right now that are negative. I want you to think about how you're feeling about your portfolio, how you're thinking about, the thoughts that come to your head about fear. Am I going to be okay? I'm going into retirement, or I'm 10 years or 15 years out. Where do I fall in terms of risk tolerance? Do I see this as a problem and I want to be more safe? And so you need to scale back. So going down and to the left is the conservative, and as you get more riskier, it goes up to the right. So if you're a balanced investor today, do you need to move down into a moderate or conservative portfolio, more into a bond fund? That's actually not a bad idea given the fact that interest rates are going up, so bonds are actually going to be more favorable in this period of time. You're going to get actually some favorable returns in a bond portfolio. It's kind of ugly as they change those bonds out, but over the period of time, you're going to be able to lock in some pretty good, juicy returns in bond portfolios. So fixed income is not a bad place. But it's all relative. I know it sounds kind of, well, that's kind of relaxed attitude, but it is all relative. I want you to pay attention to this here. This is 1 year versus 5 year rolling returns. You're probably going to say, well, of course that makes sense. But I want you to think about who you are and where you are. And I think the next slide shows you this here. No, I'll come back to it. The 1-year return, you can see in any given year, the stock market can go up dramatically or down dramatically. And as you move out in terms of timeline, you start to mitigate your risk in terms of the longer you're invested, the longer or the better opportunities you have to lower your risk over a longer period of time. So you can see that as you move out, that risk tolerance starts to lower for you. And this is what's really important for you to see, and especially depending on what kind of investments you're going to be in. If you're in a US stock versus a Canadian stock versus international versus a fixed income portfolio, and this is just showing Canadian bonds, and then versus treasury bills. So you can see that the risk tolerance in each one of those different types of investments and the return is different, right? And I want you to pay attention to that as you're thinking about your own portfolios. Why do I say it's all relative? Look at the 3-year return. If you're a young person today and you're thinking, why is everybody so excited? The market is down. So what? I'm not retiring for another 40 years. That's the opportunity. Look at the negative returns here. You've got a fantastic opportunity. The 3-year return is quite high, but the idea here is that where you are in this timeline is very important. You've got age 60 on the left side, 65 and 71. Those are typical milestones that retirees are paying attention to because of their income streams, whether it's RSPs or Canada Pension Plan, old age security. So if you're in that dark green area and you're either retired right now and you are in an equity portfolio and that's all the money you have in the world, that is probably not the best place you want to be. I'm bringing this up because that's why I say it's all relative. For me to simply say with a broad stroke, you should do this, because there are people that are in different timelines of their investment cycle. There are people entering the workforce just starting out, and there are people who are in their late 80s and they're thinking about estate planning and taxation of their portfolio. This is a very different kind of investor. So depending on where you are, you need to rethink how you're going to invest your money, rethink your risk tolerance, and then think about, okay, and inside of those two areas, what are the best places for me to invest my money given my goals and my timeline? So if you're a younger person looking at this, you'd say the NASDAQ technology is down 50%. I'm going to buy a lot of technology because it makes sense. And any young person who's paying attention to this will look at Facebook and say, Facebook is down so dramatically. Now is the time to be buying Facebook, as an example. But if you're not a young person, and anybody who is almost ready to retire or entering retirement, I want you to pay attention to this one slide. This is why I put up that timeline. In almost every presentation, I put this retirement timeline, and this is the reason why. It's called a sequence of returns. And I'm going to get my picture out so you can see everything. There we go. Sequence of returns talks about what happens when you're doing withdrawals in an environment where either the first couple of years of you starting to do withdrawal, the market is going up versus the market having stable returns versus the market having negative returns. So let's go through this quickly. The blue line going up, as you see, that is somebody doing a withdrawal, and they're doing a withdrawal when the first 2 years, the returns were positive. And you can see, and actually, if you look at the bottom right-hand corner, it says annualized returns. They all had the same over a 10-year period. They all had an annualized return of 4.8%, but the dollar amounts in that chart are different. Look at where they end up. If you look at the blue line, the light blue line going across the screen, it ends up at $586,000. The one who has stable returns, that's that sort of horizontal line going across, ends up having $537,000. And then the one that started out of having 2 years of negative returns in the first 2 years of doing withdrawals, we call them redemptions, or receiving income from your portfolio, that ended up of having $472,000. So one thing I want to make very clear for you, actually go full screen here, and that is in any one of those three scenarios, the person didn't run out of money. They had a lower value as compared to somebody else who had 2 years of positive returns when they first did their withdrawals versus someone who had 2 years of negative withdrawals their overall account balance, even though they all had the same rate of return annualized over a 10-year period, one had less than the other one. So when you begin your retirement, if you're taking money out of your portfolio and you have negative returns, it's going to diminish your portfolio faster than someone who had positive returns. And I have sort of a solution for you. So what I want you to do is take in, I'll link in the video, in the description, a video that I talk about how to actually invest this way. But you can just take out a piece of paper, and what you're going to do is you're going to draw 3 circles on it, and you can draw them like horizontally. Okay, so 1, 2, 3. So the first circle on your left is a cash circle. This is the money that you're going to take to pay your lifestyle. Okay, then the middle circle is going to be an investment portfolio that is more conservatively invested, maybe even to a balanced portfolio. And then the third circle is going to be more growth oriented, more aggressive. Okay, something that you would think long-term returns, 15-year returns. That, going back to that slide that I showed you where we talked about having longer returns and really mitigates risk for you. So what's happening here is that you want to have, especially right now, for anybody who's about to go into retirement, you're going to want to have, I would say, at least 2 years of cash in that first circle, okay, on your left. So circle on your left, circle in the middle, circle on the right. That's your cash bucket. So that's what you're going to use to fund your lifestyle over these next 2 years. Because if you remember in the slide, I talked about in the worst case of a downturn and recession lasted 25 months, and that was in 2001 we had the dot-com implosion. And that was the worst, minus 43%. So I would say to you that I don't think that we're going to have something that is as severe as that. But if you're going into retirement, instead of taking withdrawals out of your portfolio in a downturning market, you can see in the previous slide how it's more detrimental. Then just take 2 years of cash, put it into your first bucket, and that's what you're going to use to fund your lifestyle going forward for the next 2 years. And you don't have to worry about really what's happening in the markets, because you're invested in solid types of, this goes back to your relationship with your advisor, whoever you're getting advice from, that the portfolio you're invested in is actually a solid portfolio. It's got great investments. It's just suffering under the way the market is finding its rebalancing. And so that those are good investments. You just have to let them run their course and move forward, and they're going to be fine. As I've shown you in all the other slides, the markets always move up. We have 7 to 10 years of bull markets following recession. So allow those investments to not so much the middle bucket, because it's conservatively invested, but the third circle or third bucket that's going to be more aggressive or more growth oriented. It's going to suffer in the near term, but it's going to do well for you in the long term. So you don't really have to focus and say my portfolio is down so much, because you know you've got 2 years of lifestyle expenses ready to go, and it's in a money market account, so you're not having to worry about it declining over time. Your whole point to this is not trying to make money off that cash. You're just going to be in a money market account. The point to using that is to make sure that you're not thinking about my portfolio is going down. You have enough money to sustain your lifestyle over that period of time. Okay? Does that make sense? Thumbs up if everybody likes that kind of thinking. Let me know in your comments. Remember, you can put your comments. I want to hear from you. I don't want you to be too quiet tonight. I want to hear what you're thinking, okay? All right, let's move on to the next slide. Now, I've said before in other videos, if you really are concerned about the economy and concerned about where to be investing during a period of where we might be going into a recession, Canada is the place to be. Canada is actually, in the slide I showed you in the very beginning, where we have a minus 2.75% year-to-date stock market as compared to double-digit negative returns in the United States. So while you may not get the kind of positive returns that are accustomed to being in the US market, you're certainly not going to get their negative returns as bad. So you really want to, if you really want to stay even more conservative, just invest inside of Canada. Okay, So some people say, well, just sell everything and go to cash. So let's look at actually the cost of inflation and what does that mean to you. This is such a great chart. If anybody wants to know where I get this information from, please put your comment below, and I'm going to direct you to where you can actually play around with the numbers and see what it means to you. But it's a great website that you can use. So this is just look at if you take a $10,000 investment, and or if you think about the cost of goods, okay, so think about what it costs annually for you to buy milk, bread, fuel. Maybe not fuel now, the fuel is so expensive, but the staples that you would buy in a grocery store, and the annual cost of that is $10,000. And then you would need to fund that cost by some kind of investment. So if you had a $10,000 investment, what would it look like? So if you look at this, the rate of return on your investment is 5%. The cost of inflation is fairly low in this example. It's 2%, even though we're much higher right now. But if we looked at a normal time, normal life, inflation, you see that $10,000 over a 10-year period would go to $16,000. We're not factoring in taxation or anything at this point. But if you were to look at starting cost of a basket of goods and services, that cost is going to go from $10,000 to $12,000. So if you contrast that to just having cash, that same $10,000 that you have in cash only gets like maybe a 1.25% rate of return. So over a 10-year period, that cash goes up to 11,300, and the cost of goods still goes up by inflation. So it's actually sitting in cash just in a 10-year period, you're actually losing value. So this is a really good illustration of how inflation steals your purchasing power over the years. If you move that forward to a 20-year period, it gets even worse. That $10,000 investment grows to $26,000, and the cost of goods moves up to just under $15,000. If you're sitting in cash, that $10,000 has actually only gone up to almost $13,000, and the cost of goods are now close to $15,000. It hasn't changed. So now your cash is even your worst position. So being in a cash environment and thinking a long-term 20-year environment is not obviously a good idea, right? So a short period of time to mitigate, especially if you're going into retirement, this is a perfectly great strategy. But long-term, being in cash because you're just worried about the markets, this is not a good idea. Okay, now let's talk about market timing. So a lot of people are saying, well, what if I just get out of the market, go to cash? I've had this discussion with some people, not clients, by the way, but people just say, David, what should I do? Should I just sell my portfolio for cash, as a lot of people do in May, and they go away and come back in September? And typically the markets are pretty much the same. I don't think you're going to see that in this example in this year. And so the idea is, how do you time it in purchasing and re-entering the market and purchasing the same investments that you wanted to have, and just trying to time it better. So let's look at how good you might be at doing that. If you looked at continually investing your money and you never got out of the market, your portfolio gained about $18,000, okay? You missed 10 best days in the market, your portfolio only grew to almost 11,000. You missed 20 of the best days, your portfolio only grows to 8,000. And you missed 30 of the best days, your portfolio goes to 6,500. So this is actually from November 2010 to November 2020. So looking at a decade of trying to time the market, if you missed 10 of the best or 20 of the best days, that is the result of your portfolio versus staying invested. So I would encourage you to stay invested. Just change the allocation that we're going to talk about in a few minutes. Okay, here's another great chart. Get me out of the way there. This is looking at three different things here. One, that DCA means dollar cost averaging. That's when you take that middle line where it says PAC. This is you putting money in every month, pre-authorization. This is investing $500 a month, and we're talking about $6,000 a year. This is from 1989 to 2020. If you had put in $6,000 a year, you would have had a return of 7.8%, $794,000. If you had the worst days in the market, $714,000, a 6.6%, versus the best days in the market, 9.2%. So I'm going to ask you, if you think you can pull off market timing, good luck to you, because you should do a video on how to do it, because so many people get it wrong. It's very difficult to do. If you stay in, and I'm not even going into the advantages of dollar cost averaging, but if you just stay in the market, continue to fund it over time, you end up having an awesome return. So what is the impact of inflation? What is really the impact? Well, it's commodities. Energy prices are really the single biggest source of our inflation that we see today. Here is a chart I created today. This is showing crude oil versus Canadian inflation. That dark blue line that we see on the bottom, that is your inflation number. The lighter blue line, sorry guys, I couldn't change the colors. The lighter blue line above that is actually oil, crude oil. And look at the way that this moves so beautifully together. You can see as oil dropped, inflation dropped on the right-hand side in 2021. And as oil went up, inflation went up. Back in 2016, 2016, oil dropped, inflation dropped. So it is a dance partner. Oil and inflation go hand in hand. So what I'm sharing this with you is because while we have high oil prices, today, Federal Reserve has announced a 0.75% increase in interest rates. Canada will probably do the same, or at least a half a percentage point. And that is going to have absolutely no impact on inflation, almost zero impact. The only thing it's going to do is going to make everything more expensive. It's going to slow the market down. You and I are going to pay more money for our mortgages. We're going to pay more money to borrow. We'll likely go into recession. People are going to lose their jobs. I'm painting a bleak picture, but that's what happens when we go into recession. And asset prices are going to come down. But it's not going to change the price of a barrel of oil. The only thing that's going to change the price of a barrel of oil is when they change their decisions around how they view using oil, and then any political geo event like Russia-Ukraine will absolutely take care of oil. So if that resolves itself, and let's hope that it does soon, we should see oil drop. And if oil drops dramatically, inflation is going to drop dramatically. Now they're not lockstep. They're lagging, right? But if there is some kind of change in that geopolitical event, we're going to see oil is going to change and inflation is going to drop. And when that happens, things are going to become a lot easier for us, a lot more manageable, because the cost of goods is everywhere. The cost of fuel prices is being translated into our food costs everywhere you go, right? And that is a problem. Just going to check a question here. Yeah. So Rosemary, I'll just put this up for everybody. Rosemary's asking a question. I just went through that, Rosemary. Do you recommend keeping cash for 1 year when you are in retirement in case market goes down more? Where should the cash be held? Okay, so I was just saying, Rosemary, I'll just recap it. And you can watch, if you missed the first part of the video, you can watch it tonight after I edit it, I'll put it up. But I was just briefly talking about, do not get out of the market. Take about 2 years of your lifestyle expenses, what it costs for you to be in retirement, to fund your retirement, including traveling and doing all those things. What does it cost for that? Take 2 years of your cost, put it into a money market account, and then continue investing. And you could separate the rest of your money into 2 buckets. One is more conservatively invested, and the other one is more aggressively invested, because you do need equities in your portfolio in order to make sure you don't run out of money. Your portfolio has to be growing ahead of inflation. Right now, inflation is above 6%. So you do need equities in your portfolio long term. But great question. Okay, so let's get back. How are we doing so far? Is this information, is it interesting for you? Do you like it? Because let me know if you do, because I am doing my best to do so much research and give you as much information I really believe that when you have more information, more knowledge, you ask better questions lead to better outcomes. This is why I do these videos for you. Okay, pay attention to this because this is exactly where you ought to be over the next year, we'll say, okay? This is, and I have the red box around that, and that's the one thing. Oh, thanks, Ivan, for the thumbs up. Okay, when we're moving into a period of downturn, when we're moving as we're 6 months of negative returns, we're going to have rising interest rates. That's going to continue. The Federal Reserve said today that the interest rates are going to be somewhere. They're shooting for 3 to 3.5% interest rates by the end of the year. So it was why the markets went up today was because it was a clear signal to everybody that we're going to continue to raise interest rates. There's no ambiguity in that message. They're saying today's 0.75%, we've raised it by 1.5 for the year, and we're going to be raising it probably by another 2% before the year is over. So get used to this. So that was very helpful seeing that or hearing that information come from the Federal Reserve. Canada was going to probably follow along and do a similar stance on interest rates. So it's something that we're going to experience. So if we know this ahead of time, we know what interest rates are going to look like by the end of the year, and we know the economy is going to be slowing down, and we're going into a period of where we'll have slow growth, then you should know where to put your money, and that's why I'm going to share this slide with you right now. Okay. So obviously financials, and you'll notice I've got the Canadian symbol up there because if you're really uber conservative, just stick in Canada. Make sure all your investments are Canadian companies instead of going into U.S. companies. If you're uber, you want to be really safe, stay in Canada. If you don't, it's okay. You can. There we go. Okay, so financials. Financials make money in every cycle, in a recession, in an up market, in a down market. Banks make money. So you want to invest in financials. So when you're looking at, when I say this, and if anybody is not working with an advisor, if you're invested in funds or invested in stocks, I'll just talk about funds. If you're invested in funds, you're going to get a PDF. You can look at what the fund is actually invested in. It'll tell you top 10 positions. It'll tell you the geography that it's invested in, whether it's in Canada, North America, in Europe, in Asia. It'll tell you the sectors that it's invested in. And this is really what I'm talking about today, the sectors. I'm already saying to you, stay in Canada, that's the geography. And now I'm going to talk to you about the sectors that you should be invested in. So when you're looking at your prospectus of your fund, you want to go to that square that says the sectors or the weighting that it's in, and it'll say financials, 27%. This is what I'm talking about, okay? So back to this, financials, you want to have a fairly heavy weighting on financials. Consumer staples, everybody's got to eat, wash, go to the bathroom, shop. And in that consumer staples, when I say shop, we're talking about groceries here. People are going to have to eat. And because of high inflation is going to stick with us for a long time, when I say a long time, at least 2 years, the Federal Reserve also signaled today that they don't expect inflation to come down for 2 years. So be ready for high food prices over the next 2 years. So you want to have your portfolio also be invested in companies that produce food. You go to the grocery store and buy food. This is where you want to have your money. Energy. Well, I just want to say one thing about energy. Energy, as I said in the other slides, and I showed you that one slide where all the gains have been in energy. This is great. But just bear in mind that when the problem is solved with Ukraine and Russia, energy is going to fall, okay? We're going to see oil prices drop dramatically. Or if something happens between OPEC and the United States and they reach some kind of agreement to somehow lower, I don't know if that's ever going to happen. I don't see the reason why they would do it because it's making them so much money. I think we're going to see remain high oil prices. So having oil in your portfolio resources is a good thing to have over this next year or two, at least a year. Materials, these are the companies that provide raw materials to other companies that make things, okay? So car companies make cars, but they need steel, and so they got to get the ore from somebody. There's an example of a material company. Real estate. I'm going to be sharing with you real estate later. It's the last part of the slide, but real estate, we're talking about whether your fund or your investment is in real estate, so you can be invested in real estate, whether you're invested outside of the market and you're actually investing in physical real estate, or whether you're investing inside of a fund, like for instance in a REIT, real estate investment trust, then those are the areas that you'd want to be invested. Now, bear in mind, the only thing about REITs is that you've got a problem with interest rates going up. And so they're going to be interest rate sensitive. So be careful about that right now. Okay. Let's talk about real estate. Woohoo, this is a big one. Everybody's asking about real estate. So let's get into real estate. I'm going to share with you some numbers. And pay attention to this because you got to look at the details here. If you just focus on detached, okay, that's the first or the second column, but the first column just talks about all properties, and the second column is specific. All the other columns are specific types of real estate. So look at detached, and this is the GTA, okay? Average house in May is up 9% year over year. So the price in May 2021 is 9% higher in the GTA, $1.5 million, okay? A semi-detached is higher by 13%, $1.2 million. A townhome is higher by 12%, $1 million for a townhouse. Oh my goodness. And a condo is up year over year, up 13%. Awesome. But what is the real news? Look at the red box. I put it in for you. The real news right now is not so much that now I got some more slides for you, not so much that the market, the difference between May 2021 and May 2000, great, I made money in that 1 year. It's what's happening right now. Detached homes, the number of transactions is down by 41% year over year. Semi-detached down 39%. Townhouses down 40%. And condos are down 32%. So it's not so much the price year over year is down, is that people have just put the brakes on and said, I don't know if I really want to sell my house now, or do I want to buy a house now? There's a lot of trepidation around, do I get into a house right away? And because interest rates are going up, and I've been locked into a mortgage. I've got my mortgage guaranteed by the bank, but they're saying, look, you know what? If you don't get a house soon, the mortgage is going to go up. We have no choice. So it's putting a lot of pressure on people to go and buy houses today versus sitting and waiting. And so there's a lot of that going on. And so you see when people are kind of uneasy about the market, they're just not buying. You see that it's obvious. It's not make believe. These are the actual numbers. Okay, Toronto home sales, and this is very, very specific. Okay, this is for the period May 15 to June 12. If you look at the houses here, this is one thing I want to help you pay attention. This is condos in the GTA in Toronto, and you got one studio apartments, 1 bedroom, 2 bedroom, 3 bedroom, and then all the above. If you look at the far right hand corner, 1 year ago, say for a studio, okay, $468,000, and this 1 month period between May and June, it sold higher. It was up, okay, 493,000. But that's not the news. The news is go to the middle, the 3 month ago. The 3 month ago price of a condo, a studio, was $524. Now it's sold for $493. Let's go down to a 3 bedroom condo, was $1 million. It sold for $946. Those are condos. Where you start seeing is really in the townhomes and the detached. Let's look at the prices again. We already know the price has gone up, but the 1 bedroom townhouse in Toronto is actually down. It was 1 year ago, it was $762. Now it's $717. Where we're seeing the weakness in the housing market is in the lower priced point homes, so under $1 million. The homes that are like a million and above, $1.5 million above, are really not experiencing the severity in terms of the price issue. So if you look at a 3-bedroom townhouse, okay, you follow along with me. It sold for 1.2 million. 3 months ago, it was 1.3 million. A year ago, it was 1.1 million. Okay, so it's up from a year ago, but you actually lost 100 grand in terms of price over the last 3 months. $100,000. It's nothing to shake. Shake a tree, shake a leaf. I don't know. This is money. A 4-bedroom. So you think about 4-bedroom house. I've got a 4-bedroom house, and 4-bedroom house. 1, 2, 3, 4-bedroom house. Yeah. 1.6 million 3 months ago. 1.3 million today. $300,000 price, a haircut on that kind of house. So this is very interesting. If you go to a detached home, I don't have a town, detached. If you look at that, a 4-bedroom, 2.4 million, same price, 2.4 million. No changes. It's gone up in value over the period of time. So the higher price point homes are actually still going up in value. You're not losing any value. And the lower price point homes are where you're seeing a real problem in pricing. Whether or not that means if you are, people who are buying $2 million homes, generally speaking, are not as worried about interest rates going up. People who are buying lower price point homes, especially, getting into the market for the first time home buyers, young people, price point is very sensitive to them. Interest rates very sensitive to them because they usually have lower deposits into those houses unless mom and dad are helping them out. And so you're seeing that there's the competitiveness on pricing is much more, there's a weakness there. So just some more information for you about home prices and how inflation and how all of this is affecting home prices. Again, higher price homes, it's not affecting that. Home prices are going up in value. The lower price point homes are actually going down in value. And I didn't think I've included it tonight, but one of the things I also noticed is time on the market. Higher price point homes are less time in the market as compared to, when I say less time, the lower value homes under $1 million, the average time in the market was 11 days. And the higher price point was like 6 days or something. So it was not that big of a difference. Okay. The value advice. This is the last slide and then we're done. Can you believe it? I'm actually going to do it in an hour. Unbelievable. The value advice. Okay, so what is the value advice that you get from an advisor? The first thing is a financial advisor getting a financial plan done, seeing the outcome of your planning decisions before you commit to them. I say it almost in every single video, guys. When you are in, like I do financial plans for all my clients. It's part of the service that I provide for them. It's not just a financial plan, it's a living, breathing thing. We talk about it all the time. I update it all the time. When there's a material change to my client, I make the change instantly to their financial plan so that they can review it at any time they want to review it. They can go online and review it. It's one of the features that I have available to my clients. So it's like real time for them to be able to review their financial plan. It really does a lot of the heavy lifting in terms of thinking and helping you understand, can I retire now? Am I going to run out of money? How long will my money last? What kind of changes do I need to make to my lifestyle expenses, or can I actually spend more money? All of these things can be sorted out before you actually commit to doing them. And that's the value of a financial plan. And it's part of the service that I provide to all my clients. And I encourage all of you to find somebody to get you a financial plan. And if you're having any difficulty, reach out to me. I'm happy to help you figure that out. But here's some great advice. This is statistics. If you work with an advisor over a 4 to 6 year period of time, you're going to have 1.7 times more assets accumulated. So your wealth is accumulated by 1.7 times more. Over a 7 to 14 year period, your wealth is going to accumulate by 2.9 times. And work as long as you can with an advisor, a 15-year period or more, you will acquire almost 4 times the wealth of somebody if you were not working with somebody. This is powerful. And I think if you just pay attention, sort of like what kind of material I'm going through with you tonight, you can see I'm an advisor and I got my head in all of these spaces trying to figure out what is going to impact my client. What real estate is going to be impacting my client? Let's talk to a real estate broker. Here's some knowledge that we've got. How does that apply to you? How do the markets behaving right now? What can we do to make sure that you're going to weather the storm, profit from it, and it's not going to affect your retirement long term? Having an advisor giving you advice and being on top of this and having discussions with you is going to be so invaluable to you. I don't know if you can actually put a price tag on it. I know that my clients value that kind of advice. And so I would encourage you, if the one thing you do today out of this session is you just reevaluate your risk tolerance, you rethink about how you're going to invest your money differently from the last 10 years, because you haven't really had to think too hard about where to put your money because the assets have all been going up just about on anything you invested in. It's going to be much more difficult to do that now. You're going to actually have to be very tactile about what you invest your money. And that's why you might need some help doing that. So I always end this session. I don't know if I've got any questions. I'm going to look there. I always end this session by telling everybody we take care of your wealth management so you can take care of what's most important to you. There's my contact information. I will just wait a few minutes to make sure if there are no other questions. I want to see if I can get this done in less than an hour. It's okay if you got a question, I don't mind to answer it. But these are the kinds of things that I wanted to make sure that I shared with you tonight so that you have an opportunity to have more information. More information leads to better questions lead to better outcomes, and you're going to be having less anxiety, having more clarity about your financial planning, your retirement planning, and just generally just be more at ease with what's going on in the markets right now, so you can just focus on your life. Great to see everybody on tonight's live stream. I appreciate the time. 1 hour you stuck with me. I had a lot to share with you. If you like this information, remember to share it with anybody you think that would get value out of it. And no problem, Rosemary, be sure to watch the video at the end. If you have any questions, put your comments below. Remember to like and share this video. If you are new to this channel, subscribe to the channel, because this is the kind of information I do, not just on Wednesdays. I put videos up throughout the week that are on various topics that I think you're going to find useful. Again, thanks so much for sharing this time with me this evening, and I look forward to seeing you in the next video. Thanks very much and take care. Bye-bye.